Hey, welcome everyone. Good afternoon. My name is Marissa and I will be your host and administrator today. Welcome to the October 2023 First Friday webinar. Today's presentation is titled, Where is the Growth? We have been focusing on the data and the indicators, which are most likely to change the narrative, which is most likely to influence asset values over the next few years. The goal of our discussion today is to understand what future expectations are priced into asset values at current levels. Then to determine if those future expectations are reasonable based on actual data, not opinion. Our prepared comments during this session will be recorded, as other families who are unable to attend have asked us for the recording. Please note we will not record your questions, as privacy is always a top priority for our firm. Our prepared remarks today will be approximately 15 minutes long, with some time left over to cover questions from the participants, along with our standard topic, which is, what is the market missing? If you have already sent us your questions, we want to thank you. Your questions truly help us understand what topics are most important to each family we serve. If new questions arise from the content of today's presentation, please either send the question along by typing your question into the chat box or write it down and raise your hand at the end of prepared remarks. We will do our best to get to your question at the end of the prepared comments. One final note, please remember to mute your device's microphone and stay on mute, as background noise is audible and distracting. With that said, let me turn the presentation over to Stephen Abernathy, who will provide today's commentary.
Welcome, everyone. I'm Stephen Abernathy, and this is the October First Friday discussion for our family office members. As Marissa said today, we're going to address the topic that's been really bugging me, and it's been a real fly in my ointment for the past 8 months. We know interest rates are rising, and the U.S. Federal Reserve is draining liquidity in an effort to quell inflation. We know the Fed has always won these battles over, the past, 80 years or so. And in over 90% of the cases, they send our economy into a recession because increasing interest rates kills a leveraged economy. We know the economy is more than 10 times leveraged today than during the great financial crisis in 2008. So the risks today are 10 times greater than in 2008. And in 2008, I just want to remind you that the US crisis almost created a global collapse of the financial system. I'm not kidding around when I tell you that. I participated in a meeting with the Federal Reserve governor at the time, and he was visibly shaken. And this is a real tough guy. Anyway, a point that doesn't get much topic is that, unrelated to the financial dilemma we find ourselves in, we also know that the political landscape in the United States is closer to a boiling point than at any time since the 1960s. And geopolitically, the world is actually bifurcating in what may turn out to be an East versus West showdown. It's not there yet. Hope it doesn't get there, but it could. It's just a risk that doesn't seem to be priced in. All of these facts are well known, which is what makes me sort of scratch my head. It means that they should be priced, all of these risks should be priced into the asset values in the global, certainly in the US capital markets, and certainly and probably in the global capital markets by the investing public. But they aren't. Why? So the questions I've been trying to answer are why are asset values near record highs when our economy has 10 times the leverage today, and interest rates have moved from 0% to near 5.5%, thus reducing corporate earnings, which reduces the value of the stock market. Lower earnings, lower stock market. Why is the Case Shiller earnings index at 31.9 times, let's just say 32 times earnings, when the average for the last 140 years is 17 times. How is that possible? Why are investors willing to pay over 40% more than fair value when history clearly shows that US political and geopolitical tensions are rising? We're on the verge of a recession, and during recessions, everyone knows that the stock market depreciates by between 20 and 40% on average. Could be worse, could be a little bit less. As I said, I've been looking for what was missing for the last 8 months, and today we're going to show you what the market believes and what current prices tell us about future expectations, and most importantly, why current data tell us those expectations are incredibly likely to take place. Lastly, we'll show you independent research by the Federal Reserve which supports our conclusion. This is data that this is a white paper that they produced. We had obviously nothing to do with it, but it is independent, unbiased data that was just produced by one of the PhDs. So let's jump in and get to work here. In 1984, many of you will remember Wendy's took a stance that called out the rest of the fast food industry for delivering less value than they claimed that they were delivering. It was a great commercial. They claimed they claimed that there was less beef in the competition's offering than in the Wendy's offering, and that consumers should only buy the best value. Today, the current market is overpriced, and status screams, "Where is the beef?" Their only word change is, "Where's the growth?" I think you'll see as we go through this presentation that the market is priced in growth that is absolutely how would I say this? DOA. Stock market's overvalued clearly by every measure. Here's the data. And let's keep this data. Let's try to go through the data pretty quickly to keep in mind that I guess what I want to say to you, if it's not clear to you the data that we're going through, or if you don't understand it, please let us know afterward, and we'll send you the information and the supporting data in writing. Over the last 100 years, the stock market was priced at approximately 17 times earnings. This means investors were buying assets they believed would return about 6% a year. You get this, you get this number by dividing 100 by 16.9, which gives you about a 6% return. That's been the average before inflation is added to it over the course of the last 100+ years. Today, the market is priced at almost 32 times earnings, or about double what history tells us is fair value. What makes this current environment so attractive and so riskless that it commands almost 100% premium to historical valuation? What do the current prices tell us about future expectations? That really is the riddle that we have to solve today. Said differently, what has to happen in the future to make current values fair values and able to deliver returns which are in line with history. History says a 6% return is the average return for the last 140 years. So our opinion is that the current return of 3% for investors is way, way too low. What does it mean? It means that the average return for investors over the last 140 years was 6%, and current pricing is 3%. So one of two outcomes must take place to get us back to homeostasis, or said differently, to get us back to our 6% average return. Either the stock market has to decline by 47%. This will bring pricing back to the 6% level. I know this is not an outcome that anybody is terribly interested in finding or experiencing. What that means is that the current value, stock market value at around 4,200, will become 2,200, down 47%. What does it mean for current investors in the stock market? And this is why we've been so focused on helping or making sure that the families we serve are largely out of the market. If this if this takes place, every $1 million that you have in the stock market will be worth about half, about $530,000. Of course, there are alternative futures. And what happens if the stock market just stays where it is and stays level and earnings increase over the next few years? It's possible. I think it's highly unlikely, but it's possible. And let's explore that, because every analyst, every card-carrying analyst certainly will tell you that they should spend as much time on what happens if they're wrong as what happens if they're right. So this would mean that over the next 5 years plus, the S&P 500 would have to increase its earnings by 188%. This is a compound growth rate of way over 12% for the next 5 to 7 years. This is highly unlikely, and I'll go through the chapter and verse of why. It will. I hope it will become very clear to you that as to why the fundamentals can't support this and will not support this. Here's what GMO believes the returns of the marketplace will be over the course of the next 5 to 7 years. They're a reasonable company. They're intelligent, and they're data driven. And what this says is that investors in the United States should expect the next 5 to 7 years to grow at nothing or to lose money. And that is not an outcome that is acceptable for most of the families that we serve. So there are alternatives. As you can see, this chart shows that the market's unlikely to deliver any kind of returns that would be acceptable. Non-US markets will likely deliver returns which are significantly less than expected, but they're a lot less expensive. And this depends on the dollar weakening. It's a variable that it's above my pay grade. I'm not a dollar expert. I don't have an opinion on this. But what it would mean what it would mean is that the United States loses its position on the planet, and this is an outcome that it's a longer conversation than that. Now, for every investor who's been investing since 2008, they might say, hey, that last outcome that you discussed, it's possible. In fact, maybe it's even probable. Um, for the past 15 years, the stock market has appreciated by over 14% per year. It's true. It's true. And after all, um, earnings have been increasing during that whole time. I would point out a couple of things that might make that period a little bit different than the period we're entering now. First, we started from a low point. This was the great financial crisis. So just remember that we were at a point that the market was off almost 50%, and um, it was a very frightening period in our lives. This brings up sort of, I guess, what I wanted to bring to your attention is that the two most egregious mistakes made by investors are listed on this slide, and I want to make sure that you're focused on these things because we all make them. The first is investors they most often give the most attention to the most recent information they've received. It's called recency bias. It's well written about, and it's everywhere. Most investors tend to disregard the most relevant historical information in favor of the most recent and available information. It is as if they're saying, this time it's different. And we know this is seldom the case, but people do it. The second most often mistake made by the investing public is to give the most attention and the most weight on the decision to the most easily available information. They don't want to go the extra mile and do the work needed to obtain information that's most relevant. Both mistakes are quite likely to provide decisions that are less than optimal. Here's what I want to show you. We know what has to happen for the current pricing to get us back to homeostasis. Means we need to reduce prices or current values by somewhere between 40 and 50%. The alternative is for earnings to grow, as we've just brought up. Here's what I want to show you. And this is the reason that I believe that earnings are closer to a top and on their way down rather than on the way up. Since the early 2000s, our interest rate levels have been on a continuous decline. In November of 2022, many of you were here with us. We gave a First Friday webinar which explained the following. During the last 20 years, interest rates decreased continuously. Lowering interest rates increased earnings. This has ended, and interest rates are now increasing, thus decreasing earnings. Number two, we also showed that as interest rates decreased, corporate debt increased. As debt increases, leverage increases. As leverage increases, good outcomes become great and bad outcomes become disastrous. Leverage increased earnings because we could take the leverage on and not increase any net interest payments because interest levels were going down so fast. And boy, did we increase the debt. Today, the opposite's taking place. Interest rates are increasing, thus lowering earnings. yet debt loads are at record levels. My case is that this leverage is likely to lower earnings much faster than people believe today. We also showed that corporate taxes have decreased at a how would I say this, a vigorous or vibrant rate over the course of the last 20 years. As taxes decrease, earnings absolutely increase. Saying all else equal, the combination of interest rates being lower, leverage being higher, taxes being lower, all of this is at an end. It's just as likely as not that, we know interest rates are going up. We also, I don't have an opinion about what's going to happen with tax rates. However, I will tell you that it's as likely as not that corporate taxes are more likely to increase than decrease. And every investor on this call should not take our word for it. I urge you to read the first 3 pages of this document. And if the URL or the address for this document is at the bottom of the page, if it's too long for you to copy, or you don't want to take a snapshot of it, it is a really well-written paper. And basically, every investor here on this call shouldn't take our word for it. The Federal Reserve published a white paper by one of their young analysts, and the summary is exactly so. Their paper was published about 6 or 7 months after our webinar was produced, and it goes over exactly those points. And the basic summary is that corporate profits are unlikely to be higher over the near future. And by the way, you can get most of the information in the first 3 pages of the white paper. It literally takes an 8-minute read, and it really could provide you with a comfort level or a data level that will help you make intelligent decisions about your investment posture over the next few years. So, sorry to be so long-winded with that, but let's move to what the market is missing. And this is another point that it makes me scratch my head because it's right in front of our faces. We're continuing to increase wages at an alarming rate. This is one of the reasons that inflation is as sticky as it is. Higher wages equal lower profit margins. This is literally 3rd grade math. For any of you that are involved in the services sector of our market, you know that this is a one-to-one relationship. For the manufacturing sector, there's a cost of goods in there that might throw things off. But I will tell you that the services sector in the United States is really feeling this. And as you can see, or as the charts on this page show, you can see that profit margins are much more likely to be lower than higher based on wages and wage growth. And when you look at the supporting job opening market, you'll just shudder and kind of scratch your head as to how we're going to get rid of this inflation. So the summary of what I wanted to leave you with today is I think investors counting on growth in their assets based on public market valuations, which are in turn based on earnings growth, are going to be disappointed. A new strategy is needed, and you should be focusing on high quality and income generation. There's lots of sectors that have been beaten up and that are producing excellent dividends, which, as you know, are tax advantaged. If you wanted to talk about any of those topics, let me know. Marissa, did we get any questions coming in? And I'm sorry, I went a little bit long there.
That's okay. Yes, we do have a question, and this is coming through email. It says, Stephen, I call this question, is the glass half full or half empty? Today's job report shocked everyone, and the market reacted favorably so far. My thoughts are inflation, interest rates, and the economy is hurting people that quit their jobs and have been living off their savings and stimulus checks, so they must go find a job. Your thoughts, please, on what effect this report might have on the economy?
It's a good question, and I listened. I was obviously on the call when the jobs report came out this morning, and listened to a couple of the former Fed governors give their opinions, which I think have much more gravity than my observations. I don't know what to tell you. Our last First Friday meeting went through all of the reasons that our economy is not in recession and all of the reasons why our economy is likely to be in a recession in the coming months or quarters. Having a job market that is this vibrant is, according to the Fed officials, the most perplexing thing that they've ever seen. It feels like to us that the current and former administration's helicopter money attitudes and just increasingly pushing money out into the system has enabled the consumer to remain liquid far longer than most believed. And I will also tell you that I spent a great amount of time over the past 2 weeks with a bunch of bond experts, and the bond maturity, how would I say this? I guess we call it a cliff. The bond maturity cliff doesn't really begin to kick in at the retail level until 2025. The commercial real estate level, it's starting to hit, and that's going to be a rolling catastrophe. However, for those consumers who locked in home loans at 3% or below 3% or 3.5% or below, they're not going to be affected by higher interest rates. For anybody that has to refinance, it is expected that we will see 8% mortgage rates over the course of the near future. And they're well over 7% now. That's a big change from a year or two ago. So I guess the answer to the question is, and I don't know whether I'm answering this correctly or not, is that we're seeing people come back into the job market, but we're not even close to a recession. So all of my worries about our economy falling into a recession have been dead, have been early. And I'm not trying to say I haven't been wrong, because I have been. I would have thought this would have happened sooner. But I will tell you that it is unlikely that we will get through this period of increased interest rates unscathed. And with the debt load that's out there at the corporate level, at the national level, and at the retail or the civilian level, it is going to be really worrisome. Anything else, Marissa?
No, those were all the questions.
Okay, with that said, sorry to go over today, guys. If there's anything on anybody's mind that I didn't cover, or that I went through too quickly, or was just completely not understandable, please give me a call. In the meanwhile, God bless. We'll see you next month.